One of the primary reasons you lost money on a stock is because you were not looking at that company's 5 key financial ratios. Now, if you're like most people, you're probably picking stocks based purely off of emotion and FOMO, okay? Without doing the slightest bit of due diligence, okay? I'm guilty of that myself. I don't want you to needlessly lose money anymore, so I'm going to show you 5 key financial ratios that you can calculate in under 5 minutes before you decide to put your money into that company. 5 minutes of your time to prevent you from potentially losing thousands of dollars is the smartest investment decision you can make. The 5 ratios that we're going to look at are revenue growth, EBITDA, free cash flow, return on capital, and earnings per share. Starting with revenue growth, you need to see by what percentage revenue is growing at your target company year over year. You want to see steady growth in revenue between 5 and 10% for at least a period of 7 to 10 years. Okay, if it made $1 billion last year in revenue, you want to see that this year it added between $50 million to $100 million to its revenue line. Public companies have to expand their revenue base in order to attract new investors and keep their current investors satisfied. Okay, so before you put your money into a company, you need to see that its revenue has been growing at a steady pace for at least 7 to 10 years at a clip of 5 to 10% a year. Revenue growth attracts investors, and investor growth increases stock price, all else equal. Okay, that's a quick calculation to perform, takes 1 minute, no excuses. You can readily see that figure in the company's publicly available financial statements. Okay, next ratio we're going to talk about is earnings per share, or EPS. This is literally publicly available on the company's financial statements, listed right there, no excuse again. EPS is such a reliable indicator of the trajectory of a company's financial performance that it is always the first number discussed on any company's quarterly earnings calls. This number really does tell you a lot about a business, okay? The calculation is simple. It's net income divided by the current shares outstanding. Okay, you have to remember, the more shares a company sells to the open market, the less valuable its share price becomes, right? It's dilution. So if a company is able to sell shares in the market battling dilution, but also at the same time become more profitable and increase its EPS, that indicates the company is very well run, well managed, and has a competitive advantage. That company is using the stock that it is issuing to become more profitable, to invest back into its business and operations, and to increase its stock price. So we want to see an EPS number that is trending upwards over at least 7 to 10 years. Doesn't have to be by a large amount. We just want to see an upward trajectory. Now, if EPS is flat or is going down over a period of 7 to 10 years, that indicates the company is in a little bit of trouble and is not effectively using the funds it's raising by issuing that stock. Again, not looking for anything crazy or specific number, just an upward trajectory of that EPS number over a period of 7 to 10 years. Okay, the third ratio is EBITDA, which you've probably heard of before. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's basically a business's operating profit. Honestly, it's a contentious number, I'm not gonna lie, but a lot of people use it. Now, the reason it's contentious is the decision in that calculation to not consider depreciation and amortization as real expenses. Now, a lot of people say, well, depreciation and amortization are really not cash expenses. They're just charges the company's taking, right? No cash was shelled out during the period to pay for that or expense that depreciation or amortization. So it's really not a pure metric of the company's ability to produce cash flow. Now, a lot of people, especially Warren Buffett, do not like EBITDA, okay? They believe it is a phony number that can be easily manipulated, okay? He really does believe that depreciation and amortization are cash expenses, although you're just not seeing them right then and there, okay? A company has to buy equipment. It has to buy intangibles, right? It's expending cash somewhere down the line. So really not including those two numbers is not very helpful in financial analysis, and you're really missing a bigger picture. Okay, I do an entire video on income statement analysis by Warren Buffett, so check that out if you're interested in the backstory and to get more details. Now, regardless of how contentious that number is, you still want to see that EBITDA number trending upwards over a period of at least 7 to 10 years. Again, it doesn't have to be by a large amount. We just want to see upward, consistent, steady trajectories of these numbers over a longer period of time. Also, this is a number that's spelled out many times in companies' financial statements, so you don't have to look very hard for it. It should be listed right there, no excuse. Okay, the fourth ratio is the free cash flow ratio. Your free cash flow number is equal to your total operating cash flow activities minus your expenditures on property, plant, and equipment. Okay, this is one of Warren Buffett's favorite numbers to look at because it indicates a company's ability to self-finance while being less reliant on bank loans and stock to really pad its cash account. Again, we want to see this being a positive number over a period of at least 7 to 10 years, all right? If you want to learn more about this number, I go into a lot more detail in my cash flow analysis by Warren Buffett videos, so check that out if you're really interested. Okay, now the last ratio to consider is return on assets or return on capital. This number is simply your net income divided by your total assets number. This is one of a business's key profitability metrics. This number indicates the efficiency with which the business is producing net income from its assets. The relationship between net income and assets is symbiotic, okay? Net income, consider it money. With more money, you should be buying more assets. Assets produce income, which produce more money, okay? It's a symbiotic flywheel relationship, okay? You want to see net income getting poured into the assets and this number increasing over time, okay? This ratio, whatever it may be for a company, it could be as low as 5%, could be as high as 30%. Regardless, you want to see this number increasing over a period of 7 to 10 years. This indicates the company is well managed and understands that important relationship that you have to buy more assets continually to increase that ratio. Okay, that's essentially it. Those are the 5 ratios you should calculate and look at before you decide to invest in any company, okay? 5 minutes could save you thousands of dollars, all right? I want to prevent you from losing more money and making catastrophic mistakes, all right? If you enjoyed this video, I have several others that go into much more detail on income statements, balance sheet, and cash flow, okay? Hope to see you there.